Hi there, everyone. Happy Wednesday, February 26th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully, well, now kind of overcast. It was a sunny morning here in Redmond, Washington, but now kind of an overcast Redmond, Washington, but no rain. The winds that were ravaging this area over the last 2 days have subsided. We're back to kind of a normal, wet February day, and I'm pretty thankful for a little bit of normalcy around here. A lot to talk about from a technical perspective in the markets, a lot to talk about with other influences as well. It's amazing how new tariffs announced can just suck all the wind out of the sails of the major averages, which had a pretty decent morning. And I, start thinking about the show immediately when I look at the markets first thing in the morning. I usually check in right after the open to see how things played out, start to, just sort of set my priorities for the day in terms of the market activity and what kind of things I need to focus on. By the afternoon, though, after lunch Eastern time, giving back all of those gains and more. End of the day, we kind of chopped around. The S&P was essentially unchanged for the day, but a lot of movements underneath the hood. What started, and again, earlier looked like a pretty nice counter trend rally ended up being a bit of a distribution day. What's interesting is the worst performer today was consumer staples, and some of those stocks that have rallied so beautifully in the month of February today having kind of a big down day, right? So, you have this situation where the themes of 2024, kind of growth over value, et cetera, have changed quite a bit in early 2025. Today, kind of whipsawing a little back with technology at the top of the leaderboard and consumer staples on the bottom. But let's see what happens. And again, I mean, one day doesn't change the trend usually. But let's look at how the information played out. Number of people mentioning in the chat already about the webcast earlier this morning. So thankful those of you that tuned in. If not, I hope you signed up and you'll get the replay. We talked all about leadership rotation, got into a little more detail than we can in the course of the market recap show that we're doing now. But I appreciate all of you tuning in and for the very kind comments as we went along and dug into the market action. All right, with that in mind, let's talk about what happened today. So at the end of the day, this market, today's trading much ado about nothing, right? I mean, early gains for the S&P, a brief push above 6,000, sort of like dipping our head out of the water, getting a look around, and then coming right back down. Afternoon was pretty rough. S&P ended up flat, about 0.8 points higher, but that's pretty much a nothing. No change from yesterday. Unch, as they used to say. The Dow lower by about 0.4%. The NASDAQ higher by about 0.25%, although earlier in the day, of course, a much stronger move. Now, this is, of course, going into NVIDIA's earnings, and we'll talk about that when we get to the chart review portion of the discussion, because NVIDIA having some action after hours, but not that great for having a really good quarter and what appeared to be really nice numbers, good guidance for the rest of the year so far, kind of a muted reaction to there. It's like the market has thrown cold water on the whole AI trade. We're not buying it anymore, literally and figuratively. But we'll get to that chart and some of the additional thoughts on NVIDIA's earnings. Also, Salesforce, which reported after the close today. Mid caps and small caps essentially mixed. Small caps continue to underwhelm on a relative basis, tending to lag behind their large cap brethren. The VIX actually ended up pretty much the same as yesterday, chopped around a bit and moving slightly lower. Still a 19 handle, meaning 19 point something. 20 is the general level that I look for. That's what I have kind of a standing alert on stock charts that a move above a VIX of 20 tells me to revisit any sort of bullish thesis and just make sure that I'm prepared for additional uncertainty and additional volatility. Interest rates continuing to trend lower as the market now digesting some weaker economic data, as the market digesting the potential for inflation becoming a thing again, as the market, I guess, accepts the reality that rate cuts are probably not in our future anytime soon. The longer end of the curve coming down as well. And arguably, that's more of a commentary on future economic growth and skepticism that some of the changes that we're making now are going to help fuel additional economic growth. We'll see. But for now, long end of the curve coming down. The 10-year yield finished around 4.25. The 5-year yield now below 4.1%. The long bond yield sitting around 4.5%. By the way, as you'll see from a chart in a little bit, yield curve back to an inverted shape, depending on what comparison you make, which I thought that was behind us. But here we are back to an inverted yield curve. Now, a big part of that is the long end of the curve has come down so much, and bond prices have been rallying so nicely. The TLT, the AG, IEI, any of those kind of treasury and corporate bond ETFs generally breaking out above trendline resistance, continuing to strengthen. So we're generally seeing a rotation kind of out of stocks into bonds is just a generalization of kind of the dynamics that I'm observing right about now. The dollar essentially no change from yesterday, and not much of a story there from a technical perspective. On the commodity side, gold and silver had a pretty rough day yesterday. If you watch the show, we talked about that sell-off in the first half of yesterday's session. Today, essentially, popping up a little bit, opened lower, traded higher. Thinking about gold still very close to previous all-time highs. Silver and copper all in the green as well. The energy side of the commodity space, mostly in the red. Energy stocks not doing particularly well either. When you look at cryptocurrencies, now we're below 90,000, right? So big round numbers tend to matter with things like Bitcoin and Ethereum. It's actually pretty well documented. And if you've watched my shows, we've hit some of those main kind of 10,000 increments on Bitcoin or 1,000 increments on Ether. It tends to be pretty important. So now that Bitcoin's below 90,000, I think that's the level to kind of watch. And unless we can get above there and get back into that trading range that we sort of established in Q4, it's going to be a challenging chart from a technical perspective. I would say Bitcoin undeniably in a distribution phase. After we broke below 92,000, which was the low over the last couple months, I think that initiates a bearish sentiment for Bitcoin. We did grab that chart to review some of the additional evidence that we've gathered here in the last day. All right, looking at the 11 S&P sectors here, only 3 of them higher today. Technology, the best, up about 1.1%. It was up a lot more earlier in the day, but by the close, it kind of drifted lower. The utility sector, number 2, up 0.4%. Industrials are basically flat for the day, as were material stocks. On the downside, consumer staples, and again, in the last week or two, probably the strongest of the 11 sectors have been consumer staples, giving back some of those recent gains, down about 1.9%. I did grab the chart of Mondelez and another staple, which I forget, but I'll remember when I see the ticker here in a few moments. I grabbed 2 of those, ones that had rallied up to their 200-day and now pulling back a little bit. Pretty reasonable given the rally that they've seen, but worth paying attention to what key levels we need to observe there. Healthcare second from the bottom, down about 0.7%. That's another one that's done quite well recently, but not today. And then energy down 0.6%. That's one I think that has been on the struggle bus for quite some time here. Looking at breadth, we're seeing the NASDAQ breadth actually stronger with 53% advancers, 44% decliners. That's not great. I mean, that's not a blowout bullish day, but it's essentially more up than down compared to the rest of the market. You look at the S&P is kind of flipped, 60% lower, 40% higher. So, from a breadth perspective, not a great day. And again, those numbers you could see the breadth kind of rotate more negative as the day went on. All right, so NVIDIA certainly, probably top of the news today. And again, when we get to the chart review, we'll look at that in a little more detail and assess what's happening in the after hours session. But NVIDIA going into today's earnings call up almost 4%. That's the top of the list for these leading growth names. Meta, number 2, up 2.5%. Arguably Meta, the best technical configuration out of this basket by far. Sort of the only one kind of continuing to push to higher highs while other things have been struggling quite a bit. Netflix, number 3, 1.3% higher. 3 of these names were down. Tesla continuing to not see a bid at all, down another 4%. That is a broken chart from a technical perspective, I think undeniably so. Apple down 2.7%. I did grab that chart so we could look at it in a little more detail. And then Alphabet, number 3 from the bottom, down about 1.5% today. All right, shall we look at the market carpet, a heat map style visualization to help us make sense of what's happening. I love this sort of visualization, gives you the overall landscape, and then you can drill into specific themes. Already seeing a number of things to review with you really quickly. As a reminder, I can't see questions. If you're watching us live, I can see you popping questions, including Louis Giannis. Thank you so much for tuning in, my friend. Good to hear from you. Good to see you. I can see you on Facebook, LinkedIn, YouTube, and X. I appreciate you so much tuning in from any of those platforms. ask questions along the way when we get to the end of the recap show. I'll grab a question or two before we end for the day. Anything we don't get to, we'll put in the Chart This mailbag, and we're planning an all mailbag episode on Friday of this week. We'd love to answer one of your questions live on the air. All right. Looking at the heat map here, we can see a couple things. I mean, number one, kind of a modeled heat map today, right? I mean, you can see some things that are up, some things that are down, but I think this nets out to kind of a neutral beigeish color probably. And that's kind of what the markets did, right? So sort of in aggregate, the benchmarks were not really, moving anywhere by the close. But certainly quite a few themes to observe. I mean, one that jumps out to me would be consumer staples, which, arguably in recent weeks has been the strongest sector out of the 11. You've seen some emerging strength all across the board. And, going into, February, January into February, I mean, just a handful of names within consumer staples were anything but horrible. Big box retailers like Walmart and Costco, tobacco names, like Altria or something like that. But after that, I mean, beverages, food products, I mean, these were not great charts, but all of a sudden, all of that changed here in the last month or so with an acceleration to the upside. Today, kind of a mean reversion after that run, pretty normal to get a bit of a pullback. And we certainly saw that today with a lot of names like Pepsi, which had just recently broken above resistance around 155, pulling back just below that breakout level. Stocks like Coke, which are testing long-term highs. That's actually testing the high from August, September of last year, around like $72, $73. So we're kind of right back up to that point. So, sort of wait and see mode to see if it's able to power above that level. And then also others like Walmart and Costco have already pulled back quite a bit from their previous all-time highs earlier this month. And the question is, do they find their footing and rotate higher? So, good short-term strength going into today's session and giving back some of those recent gains. Looking at technology, you can see Apple down quite a bit today. And the problem I would have there is it's looking more and more like we are establishing a clear lower high today. Or this week, which is a problem. NVIDIA, of course, a positive outlier, along with Broadcom and a number of other names in this group, bouncing higher after quite a bit of pullback into it. Comes to mind, up almost 13% off of a testing a long-term low, coming off of a potential double bottoming pattern, which is pretty clear on the weekly chart. Elsewhere, what else stands out to me? I mean, honestly, it's a very mixed day. This is one of those where it's hard to find a clear theme when you're looking at the heat map, because a little of everything, right? Healthcare is a great example. I mean, there's the stocks that are up quite a bit today, like Eli Lilly, one of the better charts. I did grab that chart because it's continuing to push higher this week, while a lot of other things are not. But other names that looked like they were really starting to improve, kind of pulling back a little bit after their recent run higher. So I would say no matter how you think of today, I would describe it as a digestion day. A digestion day is you've had big moves. You've had some of the leading growth stocks pulling back. You've had some of the defensive stocks rallying. And now all of a sudden we're getting a mean reversion where they're kind of, giving back and reverting back to the previous trend for at least a day. The question is the sustainability of those moves. And if a short-term reversal turns into a long-term reversal, that's why paying attention to key levels, key patterns on the charts can be so valuable. All right, we continue on looking at the charts, the chart review portion. We'll start with the S&P. We'll talk about some macro charts, and then go through some individual names that are top of mind for me. We'll start with the S&P 500. And if you look at the chart of the S&P, you'll see that today really didn't give us much different than we got yesterday. Yesterday, we closed below the open. We had a fairly wide range relative to recent history and pull back a bit. Today, almost an identical day. We opened kind of around yesterday's open. We closed almost exactly where yesterday closed. We had a similar range, a little bit higher, but not by much. We're still below a downward sloping 50-day moving average. We're still above the 5850 level. So I don't think we incrementally added a whole lot today in terms of additional information on the chart of the S&P. I would say the same kind of framework that we've talked about still makes sense. For me, I've got two big, thick horizontal lines on this chart, 6,100 on the upside, 5850 on the downside. Both of those levels in the last 2 months, so far in calendar year 2025, we've had a failed breakout, right? So we've had a failed breakdown first through 58.50. Spent about a day or two below it before rallying back above that level. 6,100, we've had a number of times where we've attempted to push above 6,100, but those rallies have been sold and we've come back within that range. So this is the market telling you it's neutral, right? There are clear accumulation phases on this chart. I would argue there are clear distribution phases, a short version of that, July into August of last year. And then there are clear consolidation phases, which I would argue we're in right now. I mean, if you take a horizontal line from where we're at today, you will see that lines up pretty well to where we were first week in November. So from the day after the elections to today, we haven't really done much. We've chopped around quite a bit, but directionally we're exactly at the same level, right around 59.50. So again, I would say that the S&P chart at this point is neutral. There are things that are encouraging, which are the fact that we're holding support. The momentum is not that negative. The volume is probably better than you'd expect if you look at the Chaikin money flow, which I'll have for you in a chart or two. But then on the downside, we're not going up anymore for sure, right? So we're seeing an evaporation of upside momentum. We're pulling back below 50-day moving averages. So really, it's mixed bag here of evidence. I would say from a technical perspective, looking at the chart of the S&P, and again, a chart like this, I'm reminded of Jesse Livermore's famous quote: "There's time to go long, time to go short, and time to go fishing." This is one of those third buckets of like the market's not going anywhere. Now, what's great is underneath the hood, there are plenty of stocks that look quite good, and there are plenty of stocks that look quite not so good. And so I think there are opportunities, but from a higher level perspective, a top-down technical perspective, this is an underwhelming sort of consolidation phase. Which way we break is still an open question, but that's why I would be monitoring on that chart. You know, I got some questions about the Chaikin money flow recently, and I just wanted to address it here on the show. So, you know, the S&P 500 has certainly been making higher highs, arguably on weaker momentum and weaker breadth conditions. And that's been, I think, the story of the last 3 months. Higher highs on weaker something, right? Breadth and momentum. If you look at the volume picture, so this is the daily volume on the SPY. Red means it was a down close. Black means it was an up close. I don't know about you, but I'm seeing a lot more large red bars than large black bars. And what that means is that the down days, the down closes have come on heavier volume. But if you really look at it, you'll see some of these days like this gap lower, which was a down close, but look how we closed a lot above the open. Here again, we had a big gap down, but we closed more of the highs of the day. And that has happened so much that the Chaikin money flow, which basically doesn't include gaps, it just basically looks at where we close versus the high and lows every day, which is a basic comparison that the stochastics indicator, if you're familiar with that, it kind of does a similar comparison just on a longer period of time. But you know, when you look at most technical indicators, there's only a couple things you can really do to compare price, action. You can smooth it out with some sort of moving average or average level. You can look at ranges. You can look at true ranges. You can look at volume. There are only a couple like kind of basic building blocks, and most technical indicators just use different combinations of those things, which means they end up being really effective in certain markets more than others. Chaikin money flow ignores gaps because it's just looking at accumulation and distribution during the trading day and then smoothing that out over a 21-day look back period. It's about a month. And so the fact that there's so much green in the Chaikin money flow, while the daily volume looks like it's been more negative and positive, that's because some of these big down days have actually closed near the highs of the day. So even though it was a down close and it's on red on your monitor, there's accumulation happening, right? We gap down, but then people are buying that gap and pushing the close near the upper end of the range. And so that the Chaikin money flow interprets as more positive momentum, more accumulation. So what's interesting is if you've been wondering why we're not breaking down with all these big down volume days, something like Chaikin money flow can help you understand a little bit more about the trends in the volume and what sort of accumulation or distribution we might be seeing. Short answer there is for now, it remains bullish, or what Chaikin would say is in a period of accumulation. The real sell signals come when this indicator goes below the zero line. We can see a number of times here in the last 12 months where that break below the zero line has at least told us, get out of the way for a little bit. It's not perfect, right? So there are times when we break below and it's a short-lived pullback, but something to certainly look for here in the days and weeks to come is if that Chaikin money flow breaks below zero, because that would suggest that that pattern of accumulation we've been observing is no longer happening. And if you look at the Chaikin money flow in the last week, it's changing quite a bit, right? Through the sort of mid last week, Chicken money flow just ripping to the upside because we're seeing a lot of these big up closes relative to the open. In the last week, it's changed quite a bit. Not enough to trigger a sell signal, but certainly suggesting a bit of a change here. Rates continuing to go lower here. We're looking at the 10-year Treasury yield, which is $TNX on stock charts. That's actually an index that comes from the CBOE. So a lot of charting platforms kind of have that in some form. The ticker might be a little different, but it comes from the same source. Rates are going down, right, at the long end of the curve. The short end of the curve had been coming down as the Fed was lowering rates, but as the Fed rate cut cycle has been, big pause button on that one here over the last couple months, and as apparently investors are becoming a little less optimistic about a Goldilocks scenario and starting to price in, greater economic challenges or at least less economic optimism going forward. You're seeing the long end of the curve coming down, and what that means, you're starting to get an inverted yield curve again. We're very, very close to doing that by my comparison. This is not through today's close. This is actually through yesterday's close. But I would imagine, based on what we've seen today, this probably goes negative today once the end of day data is all compiled. The yield curve has been a normal shape if you look at the 3-month versus 10-year point since mid-December. Now we're going back to an inverted yield curve, and usually that just means lack of optimism about economic growth. And what a change from the end of last year, where it felt like things are great, new administration in the U.S., new optimism, business-friendly environment. Some of the announcements we've gotten have not been interpreted as very necessarily as positive as maybe we expected, and for now, rates starting to come down a little bit. 10-year yield currently is right around 4.25. That's right about where we were right around Thanksgiving of last year, before the 10-year yield pushed up to 4.8%, 4.8%. That is. We'll see if the 200-day holds here, but I would say the chart of the TLT and ag and others, clear bullish rotation in bond prices. I think that's, until proven otherwise, the new trend in the bond markets. Speaking of breakdowns, Bitcoin definitely doing it here over the last couple of days. We've seen Bitcoin finally break below that 92,000 level. I think this initiates more of a bearish price structure. This is a pattern of distribution from a technical perspective. Clear double topping pattern. If you look at the peak in December and the peak in January, we've now broken through kind of this interim support levels between those, which are all around 92K. That served as support for the last 3 months. No longer. We're actually breaking down. Almost got down to the 200-day moving average during the equity trading session today. For now, that level is holding, but that also pushes us below the 38.2% Fibonacci retracement level. If we take the September 24 low and the December 24 high, we can see 38.2%, right around 87K, and we just broke that going into today's trading. If we would hold that breakdown level and break the 200-day, I'm looking at 74,000, which would represent a 62% retracement of that previous rally, and would also line up really well with the previous high from March of 2024. We hit kind of 73K, and then that ended up being resistance for many, many months until we finally broke above it in the fourth quarter of last year. Maybe that previous resistance becomes support. This is a good opportunity, by the way. Look at the weekly chart. You'll see why that level is pretty key there. But for now, I would say the chart of Bitcoin is in a downtrend until proven otherwise. The momentum certainly in a distribution phase. I was asked about gold, and it's so funny. I was asked about gold yesterday. Is gold still in an uptrend? It's down 1 day off of an all-time high. Looking at the GLD, and we're already getting nervous. And that is a jittery market environment when I'm getting asked whether a trend is still good 1 day after the all-time high. So the short answer is it's fine. And I would say the same for charts like Meta, right? There are charts out there that are still okay. I mean, they're still actually quite great, actually. In the webcast earlier today, if you missed it, one of the things we talked about was, just because you're nervous about the market environment, even if you see clear macro signals that the market environment is getting more challenged, I am never a fan of just selling things just because we're nervous and buying something else just because we think it should work. That's what a lot of people do that don't have the benefits of being able to look at charts all the time. When you look at charts, I would rethink it. Don't think of positioning yourself for what should happen or what you think might happen. Position yourself based on what is happening, based on the trends. Let the chart tell you when it deserves a place in your portfolio, and also listen to the chart when it tells you it doesn't deserve a place anymore. chart of the GLD is still bullish, right? In terms of higher highs, higher lows, a general upward trend to the price action. We're outperforming the S&P. The momentum's clearly in a bullish range. I don't see anything on this chart yet telling me to be really nervous. I see a chart going up, and in an environment where a lot of things are not going up anymore, things that are still in an uptrend, that's where you probably want to hang out as long as possible, which means things like gold, things like Meta, charts that are in primary uptrends. I would fill a cup with that and be very happy drinking from that cup for my portfolio, if that makes sense. So overall trend in gold still okay. Again, with something like this, you use some sort of trailing stop. I'm immediately looking at the 50-day moving average, which is down around 255. That would mean another 15 points on the GLD would get you down to that level. So that's what, like 8%, 7-8% ish. My no calculator math in my head says it's about that much, we'll say. All right. Looking at some individual stocks here, NVIDIA. Let's look at what happened after the close. But before we do that, here's the technical setup going into today's earnings report. So quick story about NVIDIA. Here's the DeepSeek AI news. We all of a sudden dropped the value of NVIDIA about 20% from Friday to Monday. From there, it closed below the 200-day moving average, but did not spend much time below the 200-day. Eventually rallied. In the last week, we've actually pulled back to test the 200-day moving average again. And that's what happened into yesterday's close. Today, rallying a little bit. So now we're in kind of a framework, right? We sort of have the swing high here around 143. We have a swing low around 113. I think the 200-day moving average, which really ends up being a pretty important level to watch. So the question is, which breaks first, right? Do we break above resistance or below support? Going into the earnings call today, nice update, almost 4%, but it's really just kind of in the middle of this limbo phase from a technical perspective. Let's see what's happening after the close. So up a little bit here, right? So we're up about 2/3% to 132. So we're not much better, right? But we're kind of currently right around there. So not, and this is what if there's something that concerns me, and someone asked about NVIDIA. If there's something that concerns me, I have not had a chance to dig deep, and one of the challenges of doing a review show right after the close, after a little bit of time, is the earnings calls haven't really happened yet. I don't have time to look too much at after hours trading or dig too much into earnings releases or reaction to that. I kind of have to wait until after the show to do it. But I would say my initial assessment, because I look through it pretty quick, there's a lot to be pretty excited about. In terms of beating top line and bottom line numbers, pretty strong expectations for the year, kind of talking up AI as a still kind of a very alive theme. And the fact that the stock's not ripping in the post market tells you how little of an appetite there is for AI stories right about now, right? We've moved on from that theme. And if you're skeptical if that's the case, I would say look at what happens with NVIDIA in the after hours. We'll see as we digest the earnings, and tomorrow, after hour session is a little spotty. We'll see tomorrow when we all sleep on it and have a chance to decide what NVIDIA is worth. But if it's not up a ton on a strong earnings quarter, that would concern me as an NVIDIA holder. The fact that good earnings aren't really meaning a lot, and that doesn't necessarily mean a problem with NVIDIA. Maybe it just means that again, it's not just about how we react to earnings today. It's all about the path that's led up to today. Stock like NVIDIA and other AI names have already had an incredible run because of overwhelming optimism. And at some point, we're a little too optimistic. And maybe that's what the market is telling us here in 2025 and again today with earnings. CRM is another one, by the way, reporting after the close. This is kind of a chunky, sloppy, sideways day, up about 0.5% for CRM. But the technical story for CRM is not great going into today's report, only because we have a clear double top pattern around 365, 370. That was the high in early December. That was the high retested in late January. From there, we've broken below the 50-day, which is now sloping downwards. And we've just broken below the January swing low around 315. Let's take a look at CRM after the close. Down another 3.2% to like 298. That would put, not too far below current levels. But assuming there's a negative reaction to earnings, which it seems like that's kind of how things are playing out so far, after the close. I'm immediately looking at the 200-day moving average. You've had a nice break higher. We've had the double top. We've now broken down. So I think at best, this is a neutral chart. We break the 200-day. I don't think you could describe that as a bullish chart anymore. The relative strength is the real concern. And just look at the divergences, right? This is what, again, if the market does sell off a lot from this point on, I will write a book. I'm putting the foot down now. I will write a book about market tops, and I will highlight CRM and NVIDIA with some monster bearish divergences going into the beginning of this year as sort of warnings that, maybe things are starting to get a little bit rougher. I can't guarantee I'm going to write that book. I've been threatening to do that for years, but we digress. Apple's another one here, pulling back a little bit today, down about 3%. What was interesting about Apple going into today's session was we're just getting above the swing high from late January, which is kind of encouraging. Do we retest the previous highs? But today, sort of failing to follow through above that previous peak. Today closed almost exactly at the 50-day moving average. So in the short term, we're seeing a bit of a tactical rally. This is almost looking like a bear flag pattern, which is a higher highs and higher lows. But if and when we would break below a trend line using those lows, that would be a get out of the way kind of signal. We're not there yet. We'd have to break down to around, we'll call it 233-ish, 235-ish, somewhere in there, depending on how you draw your line. But that's what I would be watching on the chart of Apple. For now, I'm seeing the momentum be less ideal. I'm seeing a pullback after a new swing high. We'll see. Amazon, we highlighted on yesterday's show because of this hammer candle. Sure enough, we gapped higher today. Not much of an update. Earlier in the day, it looked like a big rally day was materializing. Of course, going into the close, that changed quite a bit. Ended up closing slightly below the open, but that hammer candle still holds. As promised, I have a price alert set for if and when Amazon would get below 204, 203. That would take us below that hammer candle. That would be, kind of confirming a new downward leg, essentially. But overall, short-term bounce still within a downtrend on the tactical time frame. Home Depot giving back about half of yesterday's range. We ended up closing right around 390. I'm just highlighting this chart as keeping it on the watch list of potential breakdowns. In this kind of environment where I'm finding stocks with a lot of potential distribution patterns, I always focus on that line in the sand, right? That level that if it holds, conditions are still okay. And if it breaks, conditions are not okay. Home Depot below 380 is a pretty ugly chart because that would be a head and shoulders top that is confirmed. That would be breaking a clear level of support, a 200-day moving average. If you own it below there, I would say you are ignoring the chart at your own peril. Make your own decision. As always, full disclosure. However, I would say this is the type of chart I would be avoiding below 380. That's where I have an alert. I would encourage you to do the same. Two consumer staple stocks. I mentioned earlier in the market recap how a lot of those stocks that have had really good runs in the month of February, pulling back a little bit today. And to be honest with you, there's nothing more normal in a big uptrend phase to have these big drawdown days. That just kind of happens. And it's the normal, give and take. When stocks like these rally so much, at some point they pull back. I am not surprised that charts like Hershey's, charts like Mondelez have become overbought as they're testing a descending 200-day moving average. A pullback from that technical setup makes a ton of sense. If and when we break above the 200-day, if we can complete a pullback and then make a new run above the 200-day, consumer staples, particularly these food products names, looking particularly strong, still to be determined. Another one that's sort of a challenge here, and again, when stocks are going down on good news, it doesn't make me feel great. GM, of course, updating they raised their dividend by about about 25% to match Ford's general level of a dividend. Announced a big corporate buyback. The market took that as a pretty good sign. So we closed up about 4% from yesterday's close. GM had gotten below its 200-day moving average, below Fibonacci support, and all of a sudden today gapping higher. So that's good. But if you look at what happened, this ended up turning into what's called a shooting star candle, where the open and close are near the lows of the day. It's kind of the opposite of that Amazon candle yesterday. A hammer candle is what you see at the bottom. If you flip that over, it's called a shooting star candle. It's short-term bearish. Tells you the next 1 to 3 bars, probably lower. So GM ending up not having a great after party after the announcement of what I mentioned before. Stronger dividend and a buyback, which arguably should be pretty good for investors. Market's not having much of it. Finally, what are the good charts out there? And again, I would remind you, regardless of what you think, and as much as I talk about potential headwinds, potential concerns about how things are testing support, breadth is weakening, I would never suggest to you to just sell things blindly just because you're nervous, right? Or just because you're worried about the market going down. That is not a well-documented, systematic, technical analysis strategy. The beauty of trend following is you don't have to guess about what's happening. You just have to follow the trends. You just have to follow what the charts are telling you. And so I would not ever tell you Meta is a horrible chart unless the chart actually looks horrible. The chart doesn't look horrible yet. And I would say the same of charts like Eli Lilly. This is a stock making higher highs and higher lows. This is a stock back above an upward sloping 200-day moving average. This is a stock that's starting to outperform. So if you're wondering what would Dave say to do, what kind of stocks should we be looking for if we're nervous about the environment, I would look at a bunch of charts and focus on this bottom series, which is the relative performance. Generally speaking, you want to own things that are outperforming the benchmark. And the secret that I will tell you, having worked with a bunch of institutional money managers during a bunch of bear markets before, is that the way that you outperform during a down tape is to focus on stocks with strong relative performance. Focus on things that are actually going up while the benchmarks are not doing so. Look for stocks able to make new highs while the S&P and the NASDAQ are not able to do so. Look for stocks that are going down less than the broader markets when the S&P and the NASDAQ really start to break down. The common thread with all of those three is that the relative strength line would be trending higher in each of those situations. I would be focusing on relative strength always, but especially in this kind of environment. That's kind of how you can find some potential opportunities. All right, we will take a question or two and then finished it off. Let's see. Brian Johnson, thanks for watching. You've discussed the market trend model a lot lately, and it's so funny. That's absolutely true. And when there's not much of a story, I kind of don't mention things, and then when they are, I mention them a lot. That is my strategy. I noticed that between the June and October lows of 2022, it seems the troughs in the intermediate model showed higher lows. Interesting. Okay, let's take a look at exactly what you're talking about here. Here is the market trend model to which you refer. And again, I use this every day. I just probably don't talk about it as much as I could. But I think you're referring to, let's see, let me look at your question again. Between the June and October low, like back here, yep, it seems the troughs in the intermediate model showed higher lows, like here, I'm guessing, right? So we're showing how, like a bit of a oh yeah, I see. In retrospect, could this have been interpreted as a positive divergence? So what's so funny, and I appreciate your question very much. And the short answer is, yes, you definitely could look at the trend, right? You'll see before a big change, there's a divergence. And this goes back to indicators like MACD, which have a histogram. And the histogram was kind of added later as a way to sort of anticipate the signals, right? Because the histogram tends to change direction. I mean, by definition, it has to, before we break above the zero line, right? So, in a heavy downtrend, the histogram is going to be getting lower on any of these models. Toward the end of the move, the histogram probably starts to slope higher as the downtrend is slowing down based on the calculations, and then eventually it gives the buy signal. So could you interpret that and use that histogram? You could. Do I use the market trend model that way? I do not. I designed this model to be, I don't want to say idiot proof or foolproof, but that's kind of what I was going for. I was going for simplicity. And the way that I show these as a histogram was just to easily identify when it crosses above or below the zero line. When I did the initial testing, when I went through a bunch of periods to see what it did, I didn't really look at the change in the slope of the histograms. I just looked at the signals. So that's how I use the indicator. I have a running list, a rainy day list of additional things to think about with this market trend model and riff on it, or maybe improve on it or create a newer version. Things that have come to mind have been what you mentioned, looking at the slope as more of a leading indicator of a direction change, using a signal line, which is what like the MACD indicator does. It has a lagged version, and you look at crossovers, which often signal a little earlier. Experimenting with a neutral rating. So if it's within a certain percent of the zero line, that's neutral, and that means something different. I have not done any of that work yet. I have definitely identified things I could do with this, but for now I keep it simple. But I appreciate you asking about it. And I think that's there are ways that we could certainly improve on this. For me, I love the simplicity of it, and I go for straightforward as much as possible. Um, Bachmanity, sorry. Now every time I thank you for watching again on X. Now every time I see your name, I will be taken back to that fantastic show Silicon Valley, which was just so well done. Do you use COT data, commitment of traders data? Thanks for asking about that. The short answer is I don't. And should I probably should. What you will find if you become a professional technical analyst and look at charts all day, you cannot look at everything. And so people try different approaches for this. Some people ignore everything else and just focus on their set of tools. I'm not a fan of that because I feel like other people kind of have their specialties and commitment to traders data is not my specialty. I've never traded commodities. I have found talking with people like Larry Williams, who look at COT data and are sort of experts in that space. I'm much happier following their work, asking them sometimes, hey, what are you seeing in the COT data? And so we have a community of peers in the industry, and arguably many of them are mentors of an earlier generation of my own. But a number of them talk about commitment to traders data, so I like to see what they're saying, and if they notice any significant changes, I will take a look. It is a friendly reminder, though, for myself that I don't think I've had anyone on the Market Misbehavior podcast that was digging into commitment to traders data, and I will fix that. We'll see what happens. I did see Larry, by the way, at the Money Show in Las Vegas briefly last week. Hopefully, I can convince him to come on the podcast here very soon, and I'll let you know certainly if I can do that. And I will ask him about the commitment of traders data, along with as many other things as I can come up with, and I appreciate it. Let's see. Final question, and then we'll wrap it. What book would you recommend regarding setting up a portfolio for today's environment? Ooh, that is such a good question. Boy, that's a tough one. I might have to wait on that and come back to it on the. So here's what I'm going to do. I will give you two initial thoughts, and then I will reserve the right to, in the mailbag episode on Friday, go into a little more detail after I've had a couple minutes to think about it. The one that comes to mind, though, is Bull, and I'm bringing it up, sorry, on Amazon. That's probably as good of a way to do it as ever. It's called Bull with an exclamation point, and I forget who wrote it. Here we go. Bull, a history of the boom and bust, 1982 to 2004. Now, before you get too frightened about Dave is calling a peak, you can see I bought this in 2017. I read it. I thought it was a fantastic book because it documented in detail, coming out of the 82 low and the 83 breakout, which is when the S&P or the Dow finally broke above 1,000, and it was like this big deal. Going into the tech bubble of the 90s, the late 90s, and then that rotation from the late 90s to the early 2000s. There are earlier books like, Manias, Panics, and Crashes and things like that, which talk about bull and bust, and bubbles and sell-offs and crashes before. But I thought this one, particularly documenting what the late 90s were like, how and why stocks were bid up to aggressive valuations, arguably unjustified, and then how that all unwound. While I don't necessarily think the same exact thing is going to happen, I have thought about this book a lot in the last couple of years, particularly in the last 12 months as the AI boom has, come out, and all of a sudden all these names are getting these huge rallies. I picked up that book again and flipped through some of the things that, people were talking about in those periods. I have found one of the great things you can do is dig into previous cycles. And if you have an idea what you think might happen, look at books people wrote about similar periods in history and dig into them and see what sort of things they came up with. That would be my initial suggestion. I'll think a little bit more about that, and I will try to remember to include that fantastic question in our Friday all mailbag episode. Folks, I want to thank you so much for joining me here on our live stream. Someone mentioned they just found you, found me here, and I'm so glad that you did. I enjoyed doing a show on Stock Charts TV for almost 5 years, and very much enjoyed that. And I have enjoyed very much reinventing a market recap show into its current form. I sort of broke off the interview portion and turned that into a podcast, which has led to some really fun conversations. And I'm enjoying a great deal putting out this content, and I hope truly that you're finding it helpful and it's helping you make sense of these markets in uncertain times. Thanks so much for watching. Thanks for the thoughtful questions. Keep them coming, and we'll be back tomorrow with a Thursday market update. But in the meantime, for market misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.